And then two more quickly came in. Bill asked another question. If I have an existing married put on a stock, what are your thoughts if I wanted to do a bull put credit spread on it? It's not one of the 13 income methods we discuss in the blueprint. There's a reason why. We might review that. And Shashir said, how does one deal with fear of missing out when large caps are advancing as much as they are and have? And I just got to say, if there's only a way to never risk more than 5 or 6% on a stock purchase in adverse markets, but leave the upside open to still make 60 to 70% of the movement in the underlying without doing any adjustments, that would be great, wouldn't it? And of course, that is available. And of course, that's what we talk about a lot here at PowerOptions and at RadioActive Trading. I'm going to take Shashir's question first. So Shashir says, how does one deal with fear of missing out when large caps are advancing as much as they are and have? And of course, I made the sly joke, if only there was a way to never risk more than 5 or 6% on a stock purchase in adverse markets, which would be the married put approach that we teach in the blueprint. I'm going to buy a stock and I'm going to buy a put position, which guarantees I can't lose more than 5 to 8%, even if the stock falls 50, 60, or 70% against me. But initially to start, I'm going to leave the upside open. And if the stock has a large run of 15, 20, or 25%, I'm still going to be realizing 60 to 70% of the gain in the security with having the protection in place. I never have fear of missing out if I want to enter a stock with the proper structure, because even if I'm wrong on my timing and the stock drops 30 or 40%, I can't lose more than 5 or 6 guaranteed, unlike a stop order Shashir. And if the stock continues to move up, I can still earn 60 to 70%, 50 to 60% to start, but if it keeps exceeding my expectations, I'm still going to be making 60 to 70% of that underlying gain with the cost of the put in. And we're not even talking about doing any adjustments I could do that are discussed in the blueprint, in addition to the additional structure, those 10 different income methods we use to further lower the risk and potentially bulletproof the trade. Now, on March 17th, this is in the Fusion portfolio. This is going to relate to Doug's question, Doug, but I'm going to have to shift to something different, and you'll see why in a moment. I should stop using this, and I apologize, but just an example. On March 17th, we bought to open AMD at 96.45. Okay. So let's go to portfolios here. I just created a new portfolio. Married put talk. And then we're going to enter a married put trade. Now, initially, with this capital I had in my account on St. Patrick's Day, I was looking to open 2 or 3 trades in the $40 to $50 range, 2 or 3 new married puts. But I was kind of intrigued by AMD. It was at 96.45. And at the same time, we bought the June 110 put for about $23. Okay. Now, yeah, January 110 put for $23.05. Okay, fantastic. Not 2024. 2024, not 2025. 110 put at 23.05. Okay, this is at 3/17. Date doesn't matter, but I want to be exact. So this was the married put discussion that was posted for Fusion subscribers. And this one's about 50% because of a specific reason. What do I mean by that? AMD closed today at 124.92. The stock is up 29.5%. Of course, I've lost 57.5% on the put, but that's because I've been almost 90 days into the trade, and I hadn't adjusted the put. So that's why it's only showing 12.7% instead of what I'd expect to be at around 14, 15% for the 50 to 60%. And if it continues, then I'm going to, if it went up to say 140, which would be closer to a 35% gain, this is going to be up near a 20 or 21% gain because there's not much more I can lose on the put. That 980 is all time premium. So this is illustrating my example perfectly. And of course, this relates to another question that came in. But there's 3 reasons why. Let's look at the profit and loss chart. Well, there's the risk of 7.9%, risking 950 total on the position, just about 8%, infinite upside on the trade. So, Shashir, what I'm saying here is that at this time, if I open this as a married put today, I might still be taking an 8% risk for 240 days out. But if I'm wrong, I'm not overly concerned because the most I can lose is 8%. This could drop 30 points back to 96. Now I'm still only risking 6 or 7%. Probably less because I'm still going to have a lot of time value remaining. It could go up another 30 or 40 points. And I'd still be making 50, 60 to 70% of the move in the underlying security, even with having paid for that insurance. Now, this is my old position, right? This is not the current position at 124.92. We're going to take a look at that in a moment for Bill's other question. But this is how I avoid fear of missing out. And the reason why it's not as high as I mentioned is because I've been in it for almost 3 months, for 90 days. And during that time frame, the stock went from May 17th, my purchase price at $96, almost the worst time to get in, held here, but dropped all the way down at one point to almost below 80. Okay, 16% drop, 17, 18% drop on the position. And I could have adjusted the position here. I didn't because I was worried about the trend, but I didn't think here was the time. But I could have adjusted it and lowered my cost basis total in the 96 and the 23 to that, 119 cost basis or so, what it is, to about 103 or 104 as a break even with put still out to January expiration. And if it continued to fall, well, I still might have been losing 8, 9% on the position, but I've repositioned myself to where we're back up here in this range for AMD, boosted by NVIDIA and boosted by its own earnings, of course. How do I avoid the fear of missing out when these types of movement happens? Because I'm in the proper structure that guarantees that even in the worst case scenario, I can't lose more than 6, 7, or 8%. And if the stock exceeds my expectations, we're still making 50 to 60%. Didn't want to draw there. 50 to 60%, possibly 70% or more of the underlying movement. And that's without doing any income generation on the position. The income methods in the blueprint, just selling a call to create a collar, doing one of those riskless spread trades, income method number 6, where I can get premium to lower the risk, but leave the upside open in that scenario in case there's a large unexpected move in my favor. How do we miss fear of missing out? When you see a sector being talked about in the news that you want to jump in on, but you're skittish and you're afraid. There's a new hot stock that came out somewhere across a ticker wire, somewhere on a news you follow, or some guru mentions it. The proper structure. Control your risk to single digits in case the market does you wrong, in case the stock does you wrong. Leave the upside open so we can still make a reasonable amount of the underlying movement, not even including 12 to 13 ways discussed in the full course, the blueprint, where you can adjust the position to get income if the stock's moving up, if the stock is stagnating, or if the stock falls in price. And actually, if you think the market's going to take a turn, there's an income method you can use to actually profit to the downside from the initial structure that is a bullish structure, of course. So how do I avoid fear of missing out? It's using that married put structure, Shashir, and following the rules in the blueprint and applying the 12 different income methods that are mentioned in the blueprint. Sometimes this comes up. Let's go to the search by symbol tool now. And let's look up AMD, and I'm going to stay with January. And we're going to simulate if I bought this position today, even though the market's closed. And it's going to give me a chance to illustrate something else. Usually in the one strike tool, whether you're in different bull put credit spreads, bear call credit spreads, you have these filters for less, more, and all. Well, Bill, your discussion this week, I believe, about how you were trying to identify a married put on, I can't remember, it wasn't Tesla, it was, I can't remember the stock, Bill, my apologies. But you were looking for a position in the radioactive search. Oh, it was on Fortinet. It's the one I'm already in. And you were looking for the 75 strike and you couldn't get it to come up in more or all results. So what we did in the week is I told Greg, hey, I think this might be a good idea. Now if you go to the married put structure and you go into search by symbol, instead of just using less, more, or all results, so the more results will give you more strikes. But with the stock trading at 124, you'll also see out of the money puts that take that double digit risk, which are not what we'd follow in the radioactive screen. But an investor might want to be okay taking 16% risks. They want it to pay a lower cost. The idea of this tool is to show you different strike structures that are available so you can make the choice. But if you're following the radioactive trading techniques, now there's a quick fix. Just go to radioactive results from that filters dropdown, and you're just seeing the married puts that match the criteria discussed in the blueprint for the proper risk, proper range in the money for any stock, not the one that matches our stock criteria. And as I mentioned here with AMD at 124, the preferred married puts would be the 135 at 8.4%, the 140 at 7%, and the 145 at 5.8. This lets me illustrate something that I like to call the three bears. When I'm analyzing a married put position, and I don't want to typically go more than 4 or 5 strikes in the money. I don't want to go more than 20% in the money from the current stock price because that lowers my expectancy of profit, even though the risk would be lower. So I see these three here. What are the advantages of each one? Well, very quickly. The lower strike put at 135 is still 10 points out of the money, but it's going to take on the higher at risk because it's closer to the stock price on the ATM bell curve. So the time value is inflated. That's the risk. The maximum risk is the time value on the put that you're purchasing. The remaining $10 here in this case, roughly $9 and some odd cents, is, it's $10.10, I apologize, but the extra $10 there is the intrinsic value. Guaranteed to get that back. The 1232 is the extrinsic value, the time value. The advantage of this married put is that I could start probably doing some income methods right away to start lowering this down by selling a 135, 140 call, something along those lines. Not what we do, not what's taught in the blueprint, but I need less of a move to make more sense to start applying the income methods that's discussed in the blueprint. 145, great risk, only 5.8%. AMD could fall 50% tomorrow, and I'm guaranteed that I can't lose more than 5.8%. And the volatility would probably increase on this put. So, yeah, but I'd be way too close to intrinsic value. But if the implied volatility increases, that time value should increase as well. So I might get out with actually much less of a loss of 5.8, even with a 50% drop. But I'd need the stock to be trading up near 145 before it made sense to apply the bullish income methods in the blueprint. Reasonably, following the guidelines. Has a lower expectancy of profit. The deeper I go in the money, I have to wait longer for the stock to reach up to 140, 143, 145. So what do we have here? Low risk, very conservative, need more time for the stock to move up before it makes sense to apply the income methods. High risk, don't want to necessarily know if I want to take more than a 7, 6, 8% risk on the position. But again, 8.4%. I could start doing income methods right away, but I'm getting close to that double-digit range. Not too hot, not too cold, not too hard, not too soft. The three bears right in the middle. That would probably be my target. Is that probably the best stock analysis and strategy analysis you've ever heard? No, it's probably the worst. But since I've been trading the married put since 2008 and 2009, this is what I typically find when I see three in the range that match what I look for in a married put in the range I want of, say, 4 to 9%, 4 to 8.5%. I usually apply the three bears. Not too hot, not too cold, just right in the middle. I'd likely be taking the 140 put on AMD at 7%. Now, where am I going with this? Bill's follow-up question. If I have an existing married put on a stock, what are your thoughts if I want to do a bull put spread on it? I don't. If you want to do a bull put spread on it, you can. It's not one of the 13 ways we discuss in the blueprint to manage a position. And it's because that particular income method, that adjustment onto the married put, increases the risk to the downside. For example, let's just take a look. Go to the profit and loss chart. You heard me mention about income method number 6, riskless bear call credit spread. Now, I wouldn't do this, and this is not a recommendation or suggestion of a married put. This is to illustrate to Shashir, how could I enter a position and not have fear of missing out when large caps are advancing? Well, this is it. This is the structure I use with 50% of my portfolio for that reason. So I don't fear missing out when there's large unexpected movements. I also don't hate myself for saying, oh, I mistimed it, I should have known better. Because even if the market pulls back 10, 15, 20%, my stock drops 20, 30, 40%, I can't lose more than 5 or 6%. It's the whole point of this structure. You don't have the fear of missing out. You're trading with a safety net to take advantage of the upward movements and still apply income methods, while at the same time protected and secured if the bottom falls out for any unexpected reason. Back to Bill. This isn't a bull put. I'm going to sell a 140 call and buy a 145. What does that look like? Well, that's a bear call credit spread, isn't it? Selling the 145, my apologies, selling the 140, buying a 145 would create our bear call credit spread as long as the stock stays below 140. Both calls expire worthless. We keep the net credit. We'd have to put up the margin to cover the position. I have to cover the difference in the strike prices. Now, right here, my maximum risk is 1030 or 6.9% with just the basic structure we entered. Now, and I do this income method. This is income method number 6, by the way. You want to get the blueprint to see why, how you would place this and manage it. The risk drops down to 6.5%. The monetary risk dropped down to 967. I entered a bearish spread on a bullish position that required margin, but my risk went down. My max profit, it stayed infinite. Why? Because I don't have to cover the margin in the bear call credit spread against a married put. I have a stock. I have a put protecting it that's long term. I'm selling a near term call. My broker just sees that as a covered call. And then I'm buying an extra long call at a higher strike price for lower cost. So I keep a net credit to lower my risk, and I leave my upside open. No margin is required, Bill, so the at-risk amount doesn't increase. Now, I entered this position following the rules in the blueprint, my expectation that I think the stock's going to move up 3 to 5% or so in the next 30 to 40 days. That's what I look for when I open a married put that's talked about in the blueprint. So, hey, I'm bullish on this position. Why don't I go out those 14 days? Let's keep the math simple. Let me sell a 120, buy a 115. I'm going to get a pretty high net credit here of about $1.60 or so between the two positions. I'm going to sell a 120 put, buy a 115. I know that's really close to at the money, but hey, I'm bullish. What's the worst that could happen? Well, now the risk goes up to 1366. 9.2%. And I did get, as I mentioned, a good net credit. Let's just call it $1.70. But I have to cover the 5-point difference in strike prices because the stock does not cover the obligation of the sold put. Remember from a previous discussion. Excuse me. When you sell a call as in a short strangle, you're obligated to deliver shares of stock. If you're in a covered call, it's okay. You own the stock. It's just assigned. If I'm in a short strangle, I don't own the stock. It's a naked call. So I end up being short the stock. In this structure, I own stock and I own a put. When I sell the 120 put, the stock does not cover the obligation to buy more shares of stock at 120. It doesn't negate the contractual obligation to buy more shares of stock. Now, the 140 put, you could say, yeah, that's a calendar put spread, so it's not as much margin. But now I'm buying a 115 put. See, if I just sell the put against this, what happens? Well, the 140 put now can either cover only the stock or the cash secured / naked put. It can't cover both. The risk would go up to 50% to the downside. But I'm buying the 115 put. But again, still my risk goes up to 9.2%. But I'm bullish on the stock. What could go wrong? 16, 17, 18% decline from where we got in the position at 96. And that's not 96. I'm sorry. I apologize. I said that wrong earlier. We got in about here, and 3 to 5 days later, it did move up the 3 to 5% we wanted, up to about 101, 102. Then it fell down to almost 80, 16, 15-point drop, which means I'm losing on the bull put spread, taking the extra loss. I have to close, roll, or adjust the bull put spread, which is doing what? Adding to my overall risk on the initial married put position. We would have moved from that 7% risk up to about 9.2. I would have had to close the bull put credit spread. Maybe I roll it down and it keeps going. After that first 14-day cycle, it falls 8 points, 9 points. Then I roll it down. Then it falls another 7 to 8 points. So that's 16 points down. I got to close that. Now I'm at 11.2% risk on the position. It's going in the wrong direction for me. So that's why the bull put credit spread against the married put is not a preferred income method. I have to erase the drawings. That's what I'm trying to do. But the real answer to Bill's question, in that case, if I have existing married put, what are your thoughts if I wanted to do a bull put spread on it? It's not. It increases the risk because you have to cover the margin because the margin is not covered due to the obligation here. I don't do it even if I'm bullish on the stock. However, the married put position is a bullish strategy, and I am selecting stocks that I'm bullish on over the long term. If you're comfortable with the additional at risk on the position in case the market turns and the market falls, you can do that. I'm not going to have discussion on it. I'm not going to have videos for you on it, aside from maybe this one and one other one when we addressed this before, about managing it, adjusting it, doing anything like that, because it's not something we do. It's not something we teach. It's not something that's in the blueprint. You're going out on your own on that one if you want to do it that way, and that's perfectly fine. I have investors that do it. I just don't. Have I missed out on profits before? Yes. Have I saved myself from additional losses? Yes. Following the rules in the blueprint. So I think for me, over time, it has evened out very well. All right. So that's it for a rapid fire. Not too rapid, huh, Mike? What did I tell you about going off on a tangent? But those are pretty important.